Hello, this is George, guys. Welcome back. We're going to move into the next video, which deals with explaining how the core business activities of an entrepreneurial venture, or any company for that matter, drive the financial statements. Now, the principal financial statements work together, as we have heard, to communicate the various business activities of the venture. What I want to stress now is that there is a logical connection between these business activities, which we've discussed. Remember, financing, investing, operating, and the financial statements. So you may think of a venture in the following frame. You start out with goals and strategies. Your goals essentially are what you want to do. Your strategy is somehow defines how you're going to go about achieving those goals. And then you have to somehow get the necessary financing in place to be able to make investments which will help you build the infrastructure to operate. So these are all tied together in this sense, but let's break these out now in a little bit more detail to understand how the financial statements are derived. Now, when you talk about financing, when you talk about, you're talking essentially about notes payable, accounts payable, salaries payable, income tax payable. Now let me explain these in a little bit detail. A note payable may be something that you obtain from a bank. They lend you money in a sense you're going to have to pay that back over time. An accounts payable is something which comes from your suppliers. They may give you material, inventory on account, and you have an obligation to pay them back. Now, in fact, that obligation is a source of financing that they're providing you with some flexibility. And some entrepreneurs have been very clever here, being able to utilize trade credit or accounts payable to be able to build the inventory, develop the inventory, which they then sell within a short period of time, and have essentially built the initial stages of their business based upon accounts payable financing. Salaries payable. Now, this may seem strange as a source of financing, but think about this. Let's say that you go to your brother-in-law or sister-in-law, and you say, I can't pay you now as I launch this venture, but I'll be able to pay you, I think pretty much, I'm pretty confident, within 3 months or within 6 months. In essence, what you're doing is accruing or building up a salary payable, in this case, to one of your relatives. Now, again, entrepreneurs have been quite clever in using this source of financing to be able to grow their business. Now, of course, you want to be credible. You want to be sure that there's a good chance that you will be able to pay this obligation. But if you express that this is risky and your relative or your friend signs on, you essentially may be building a way of financing your business through salaries payable. Now, taxes payable means the government is financing your business, that you have tax liability based upon your profitability that you owe the government. Most governments are pretty quick to collect this, so this may or may not be a great source of financing. But the point I'm saying here is that these are sources of financing which are typically current. In other words, the obligations are going to be coming due within a short period of time, usually less than a year or so. On the other hand, you can have longer-term financing. Maybe your uncle decides, hey, I've always believed in you as an entrepreneur. I'm going to loan you $5,000 or $50,000. Then you have a bond payable or a note payable. Bond typically implies a longer-term duration. That's a long-term source of financing. Or maybe your friends invest in your company initially and take stock, common stock. Retained earnings essentially means that once you get going and you make profitability, you're profitable, you retain those earnings inside the company as opposed to paying out dividends. So consequently, what you have here is a source of financing that comes from your earnings, which you retain inside the company. The key point here is that all these sources of financing are going to make up what we call the liabilities and shareholders' equity part of a balance sheet. Liabilities and shareholders' equity. Sources of financing that comes from obligations, liability obligations, and shareholders' equity from equity, common stock, or other types of stock that you've sold to your shareholders. That's the financing piece. Let's look a little bit now about the investing piece. You may invest in cash, and as I described earlier, sometimes companies hold cash for various reasons. To be able to provide liquidity for future debts, to be able to make investments, maybe make an acquisition. Accounts receivable. Accounts receivable has to do with an asset that you have earned based upon the fact that you have sold something to a customer, but they've not paid you yet. That's an investment that you're making. When you provide a customer with credit, you're essentially making an investment in that receivable. You may have to build inventory, or you may hold other marketable securities, some other firms, if you have excess cash. You may invest in longer-term investments, assets, such as land, equipment, patents, other types of long-term investments that you may make. Now, all these investments are going to make up the asset side of the balance sheet. Now, it turns out, as we'll see, that not all investments you make will be reported on a balance sheet. This will become a very important part because you're not able to somehow recognize certain of these investments. And yet some of these investments may become very important. For example, you may invest in a sales force to train a sales force. Even though that's investment, because that sales force hopefully will benefit you over a long period of time, you can't put that training investment as an asset on your balance sheet. So there are rules and regulations to determine what can actually be put on an actual balance sheet. But for right now, keep the thought in the back of your mind that as important as your balance sheet is, it may not include all the important investments or assets that you're building. And we'll talk more about this in another video. But I want you to think about this initially right now. Then you operate. Here you go. You're off and running. You've got sales revenue, and you've got cost of goods sold. In other words, what did it cost you to manufacture that game or whatever you're developing? You've got selling expense. You have to pay salespeople, or you have to pay commissions. You have administrative expense. You have to pay yourself, or you pay your management team or other people that are involved. If you've borrowed any money, you have interest expense associated with operating. And then you have income tax expense or other obligations that you have to government agencies. All these operating expense activities lead to the income statement. So isn't it interesting that the principal financial statements, at least two of them, the balance sheet comes out of financing and investing activities, and the income statement comes out of operating activities. Please keep these three activities clearly in your mind: financing, investing, and operating, because they're going to be the cornerstone for much of the work and much of the thinking you do about communicating financial information. So in summary, there are three domains which are important to an entrepreneur and any venture. The financing domain, which generates liabilities and shareholders' equity section of the balance sheet. Again, that's tied directly to that part of the balance sheet. The investing domain, which produces assets, the asset part of the balance sheet. So financing and investing drive the balance sheet. And then there's the operating domain, which produces, which yields net income or the income statement. Once again, the key idea here is that the financial statements simply don't come out of thin air, that they're tied directly to these three domains: financing, investing, and operating. Now, there's one financial statement which we've not yet touched on in any detail. That's the cash flow statement. And we'll see how important this is and how this is also related to operations, investing, and financing. But that will be the subject of a later video. Looking ahead, We want to talk now in a little bit more depth about the balance sheet and specifically how we recognize and think about assets on a venture's balance sheet.